Hi, everyone. Welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week, a lot to discuss. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So let's start out talking about markets. First half of the year, very difficult. There's really no place to hide for stock and bond investors. If we look at the S&P 500, down 20% in that first half, the big difference in that first half was that bonds really didn't provide any cushion to that. So down over 10% in the bond index. That's the first time we've ever seen double-digit percent declines in both stocks and bonds at the same time. So if we look at the last times the S&P 500 is down in a particular year, we've always seen bonds up to cushion that blow. And the reason for that is typically when you have a large decline in stocks, it's associated with recessionary fears, and you see interest rates fall and the Fed cutting interest rates, and bond prices rise. This year, we're seeing the opposite. Obviously, the cause of the stock market decline, at least one of them, is rising inflation and rising interest rates. And in addition, the Fed is, of course, hiking interest rates. And so we're seeing both stocks and bonds decline together. Now, the result of that for 60-40 portfolio investor has been the worst start to a year in history. We're down 16% for 60-40 stock bond portfolio. As you can see in the table here, nothing else really compares to that. Even in 2008, the 60-40 was only down 6.7% at this point in time through the end of June. So very difficult year thus far for stock and bond investors. Now, what do investors typically doing or thinking about doing after a big stock market decline? Well, you tend to see capitulation. Investors want to minimize the pain, and there's a temptation to just sell and wait till the news gets better before you come back in. And if we look historically, is getting out of the market after a big decline, has that been a good strategy for long-term investors? Well, looking at this table here, it seems clearly no, that hasn't been the case. This is a table looking at the Wilshire 5000, so a very broad U.S. equity index. And these are the worst declines, 6-month declines in history. And here's what the forward returns were. So looking out 3 months, 6 months, 1 year, all the way up to 10 years, how did the stock market do following these big declines historically? As you can see, in the short run, the market can do anything. It can continue to go down, or it could bounce back. That shouldn't be a surprise to you. But if you look out longer term, what you tend to see, at least historically, after these big declines, is gains for investors. And so if you have a long time horizon, 10 years plus, if we look at the past, it's been a poor strategy to sell after a large decline. We've seen positive returns every time looking out 10 years. And also above average returns. So it's actually been a better time historically to buy after a decline than just any random time period. Now, what are investors feeling? They're not feeling that they're not thinking about the long term. They're not thinking about 10 years. They're thinking about the next 10 days or 10 weeks. And most investors don't feel this is a bottom. So I did a poll here. 78.7% said this is just a dead cat bounce that we're seeing, and we're going to see lower lows ahead in the S&P 500. So sentiment still very bearish in terms of equities. And why are people feeling that we're going to see lower lows ahead? Well, this other poll I did, I think, really illustrates that. There are many reasons today why one could make the case that stocks are going to have continued decline. So just in terms of the economy, we're going to see worse news. Earnings are likely to get hit. Housing prices are likely to come down. The Fed is still hiking interest rates. For all these reasons, investors are feeling that stocks could continue to go lower. And that certainly may be the case, but it's just important to remember that at a certain point, we're going to hit a bottom and the news is still going to be bad, and stocks are going to go up, and everyone's going to be wondering why that's happening. If we look at March 2009 or March 2020, we saw that happen. And the news was continuing to be bad, and everyone's saying, well, this is just a false rally. This can't be a bottom. but of course it was. And so what's going on there is that stocks are a leading indicator. They're forward-looking. So when there is a bottom, and we may or may not be there, certainly could be more pain ahead. You have the expectation that news will continue to be bad, for the foreseeable future, and stocks are looking out past that bad news to good news ahead of that. So here's a question everyone's asking. Are we already in a recession? Are we already there? And for most people, it seems like it feels like they are. And if we're looking at data points, I think they're starting to pile up now. So I think the odds of a recession week after week seem to be growing. And here's a latest indication of that. If we look at the ISM manufacturing index and look at the spread between new orders, so orders, new orders of goods, and we subtract the level of inventories. When this has been this negative in the past, we've oftentimes already been in a recession. So if we look at 2020 or 2007 to 2009 recession, 81, 82, 80, or 73, 75, all these times we were already in a recession when we had this spread between new orders and inventories this negative. Now, no indicator is foolproof. We saw in the 1966 bear market, it hit these negative levels. It would snap back quickly from there, and we didn't see a recession. So could that be the case again today? Yes, but again, if we're putting this with other indicators that we've talked about, like consumer sentiment from University of Michigan being so low, and the fact that we already have a negative GDP print, and we're likely or increasingly likely to have another one here in the second quarter, the odds of a recession are building for sure. So let's talk about a market-based indicator looking at the yield curve. So back in April, we talked about this spread between the 10-year Treasury yield, so a longer-term yield, and the 2-year Treasury yield. And when that 10-year Treasury yield falls below that 2-year Treasury yield, in the past, that's been a pretty good indicator of future economic weakness. So we saw the first inversion back in April, and now we're seeing one again today with that 2-year Treasury yield 3 basis points above the 10-year yield. And we talked about back then what that has meant historically. It's always preceded a recession with this inversion. And typically there's a reasonably long lead time. Now, how does that square with the fact that most people are already feel that we're in a recession? That remains to be seen. So maybe we're going to break all the records here, and the lead time will be even less than what we saw in 2020, which was just 7 months. But most people are feeling like we are already in a recession. If you look at this poll here, 59% that I did, that's a pretty big number. And so the yield curve, we have the ISM number, we have consumer confidence. So again, indicators are building. The stock market, of course, and doing what it does is indicating some economic weakness as well. So the indicators are piling up. Here's another one from consumer confidence. And this is from the conference board. So we looked at the University of Michigan in the past. This is really confirming that data. And consumer confidence is going down. And importantly, this conference board also polls people about how they're feeling about the future. So it's called this expectations index, looking out 6 months. And this expectation index is at its lowest point in over a decade. And so this is pretty important, because if people are expecting the next 6 months to be worse, they might pull back in their spending. And of course, consumer spending, consumption is a big, major part of the US economy. And if we see really a downturn in consumer spending, I think that would finally confirm for everyone that the recession is here. So if we're looking at the actual real GDP data, again, we got that slightly negative print in the first quarter. In a few weeks, we'll get the reading on the first reading on the second quarter. But here's the Atlanta Fed is estimating a second down quarter for the U.S. economy. If we look at other big banks forecasts, they're still forecasting a positive number for Q2. So we'll see what ends up happening. If this ends up being a good indicator of a downturn, I think it's certainly possible we could see another negative quarter. Does that mean, if that does happen, does that mean we're in a recession? Not necessarily. A lot of people think that 2 consecutive quarters mean that you're in a recession, but actually in the U.S., it's this NBER, the National Bureau of Economic Research, that says whether we're in a recession or not. And so how they define a recession isn't just simply 2 quarters of negative GDP growth. They define it as a significant decline in economic activity that's spread across the economy, lasting more than a few months. And that's normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So they're looking at a number of indicators, not just real GDP, to determine that. So that's certainly one factor. But they're going to be looking at these to say at a certain point, and again, it's going to be backward looking, because at that point we will already have been in a recession. But they're going to say the recession started at X date because of these indicators. And if we're looking at these indicators, and we'll talk about this, like, I think the big one that's kind of pointing to a recession, obviously, is that real GDP number. But the one that is suggesting that we're not yet in a recession, perhaps, is the employment numbers, and we'll talk about that at the end of this video. So we still have some mixed signals. Technically, I don't think it matters very much whether someone says we're in a recession or not, because many people are feeling it. So just looking at those consumer confidence numbers, if they stay that low, it really doesn't matter, because it's likely good to impact the economy in a meaningful way. So technically or not, it really doesn't matter. And typically for the stock market, again, by the time the NBER tells you're in a recession, if we look at 2020, or we look at the recessions in the past, by that point, it's usually been way too late to do something about it. And in terms of the stock market, again, is a leading indicator. So if you say 6 months, 8 months, 10 months into a recession, you say, oh, we're in a recession today, well, the stock market will have already declined significantly at that point. And we talked about looking at the Wilshire, what happens following big stock market declines. So interesting thing to look at, but is it meaningful if you're a market participant? Probably not. By the time it's officially announced, probably the worst will have been over, and the market will have discounted that at that point. So let's look at some encouraging signs on the inflation front, and with inflation abating. So here we have gas prices in the U.S. as a map of U.S. states and gas prices. And gas prices are down over 30 cents a gallon from their peak in mid-June. So we peaked at a little over $5 a gallon. We're at $4.68 now. So we're seeing prices come down. Why is that? Well, we're seeing the price of crude oil come down. So that's certainly a good thing. And so this is a relief, and I think a lot of people would like to see more, but certainly a good start for people to see gas prices coming down. We're also seeing important industrial metals really start to show declines here. This is the price of copper. It's at its lowest level since 2020. So a pretty good decline here in the price of copper after peaking earlier this year. And if we look at agricultural commodities, and we've talked about this, but the declines have really accelerated. This is the best news I can think of here, because the prices of food obviously very important for people, and corn, wheat, and soybeans all down over 25%. So we're seeing this pretty much across the board, pullback in commodity prices. Another thing we're seeing is used car prices. If we look at the last 6 months, they're actually down 7%. And if you remember, in 2020, used car prices were one of the first to really start to show signs of an increase, well ahead of broad CPI inflation increasing. So hopefully this is a leading indicator of the rate of inflation perhaps being close to a peak. The market is suggesting that we're likely to see a decline if we look at things like break-even inflation rates. And if we're seeing looking at core personal consumption expenditures, this is something that the Fed looks at very closely. We saw this number peak a few months ago. It's now down 3 straight months. We're at 4.7% today. The peak was 5.3%. So the signs are kind of building. If we're looking at broad CPI, which is going to come out again this week, the expectation actually is that it's going to show another increase to 8.8%. So we'll see what happens there. But all of these signs are starting to build that hopefully perhaps at least the rate of inflation is at or near a high. So hopefully that's the case. If we're looking at the shipping rates, this is an index looking at global container shipping rates. And as you can see, they just exploded higher. And there's many reasons for why. And we've talked about that in the past, supply chain issues. But we're starting to see a meaningful reversal here. So again, this is another positive thing. So if this comes crashing down, we have less of an impetus for rising prices because it's a big input in terms of the cost of transportation driving price increases in goods. So another good sign. Hopefully, this is an indication that the supply chain issues are starting to abate. I think if you look at the respondents in the ISM survey, a number of them started to talk about that really for the first time last month, saying some of the supply chain issues have been are alleviating somewhat. So hopefully, again, that continues. Now, there's many different ways to think about inflation and why we have inflation. But I think the best explanation, that one that makes the most sense, is there was too much money chasing too few goods. And that's kind of a classic definition of inflation. Of course, in 2020 and early 2021, we decided to borrow a lot of money. We also printed money and sent it out to people. And that huge amount of money was now in the system. And of course, it's now trying to buy excess money is trying to buy that same quantity of goods or even a lower quantity of goods because of the supply chain issues. And that's pushing prices up. So it's interesting to see the response here from California, where they're going to do another stimulus check just for the California residents of up to a little over $1,000. They're calling it inflation relief. And I think this is kind of just fascinating. And it seems like most people seem to be in favor of it there, but it's fascinating because the cause of the problem has now become, at least for California, the solution to the problem. So the cause of the problem is sending out free money to people is now they're looking at that as a solution. And of course, this will only push prices up further, right? So if we did it nationally and let's say we borrowed another $1 trillion or $2 trillion and sent it out to people, immediately it would feel very good, but eventually it's going to find its way work its way into the system and drive prices up even more. So very interesting to see. You can understand why politicians want to do it. In California, it's very popular to send free money to people, and they're trying to get reelected, of course. But it seems almost ridiculous to think that this is going to be an effective solution. Again, people will feel happy about that, but they won't be very happy when inflation goes up even more. So let's talk about one way to make housing more affordable. And we've talked about the affordability crisis with U.S. home prices, and it's just really continuing. If we look at the Case-Shiller National Home Price Index, it hit a new all-time high for the 39th month in a row, up 20% over the past year, 38% over the last 2 years. So just stunning increase. If we look at things like housing prices relative to inflation, to me, this is kind of the primary chart to say that we're in a second housing bubble nationwide. We're at the highest level we've ever been. So home prices outpacing inflation by 135%. That's higher than the peak that we saw during the housing bubble of the mid 2000s. And if we look at really the rising tide in home prices have really lifted all boats. So every single major metropolitan area in the Case-Shiller 20 City Index is at an all-time high and up over 10% in the last year, with a number of cities, Dallas, Phoenix, Miami, Tampa, all up over 30% in a 1 year period. So just huge increases in price. And of course, people's incomes are not going up anywhere near that rate. And so what you have is really a disconnect here. And this chart really illustrates that perfectly, where the average new home price is now over 10 times per capita disposable income in the US. We've never seen it that high in history. So what does that mean? It means home prices are not affordable to the average family anymore. And if we look at this housing affordability index, we're back to the lowest level since July 2006. And why is that meaningful? Well, that was the peak of the last housing bubble. And from there, home prices nationally would decline 25% if we're looking at that national index, with many cities getting cut in half or more. So one way to make housing more affordable, of course, is to just let the market do its job and prices to come back down. As you can see, after the peak of the housing bubble in 2006, prices went down, affordability went up. So there's a number of different ways you can make housing more affordable. The other way would to be for the Fed to start manipulating interest rates again and buying up the mortgage market, driving mortgage rates back down. I don't think that would be a good idea. That was part of the cause, of course, of this housing bubble, was the Fed coming in and buying mortgage bonds and pushing rates down to record lows, even though home prices were going up. So I don't think that would be a good idea. But this adjustment's going to be painful for people to witness. We become accustomed again to home prices only going up. And when we see a reversion in that, I think psychologically it's going to have an impact on people. It tends to be an important indicator in terms of how households think about spending. So if we look at periods where home prices are falling, people are in general less willing to spend money because they're feeling like they have their net worth is going down. So something to watch here. Affordability is just as we talked about, at a level that's really not sustainable. So home prices, demand has to come down because you don't have the average person being able to afford the average home price, and therefore demand is going to come down. We've talked about home sales have come down, and that's the first sign, but now we need to see prices kind of abate as well. So let's talk about this transition here in terms of the Fed from quantitative easing to quantitative tightening, and just look at where we are in the cycle of that. This is a chart showing you the Fed balance sheet over time, and the percentage below the all-time high in that balance sheet. And as you can see, we're just getting started here in terms of quantitative tightening. We're still less than 1% below the record high in terms of the Fed balance sheet. So we have a long way to go in terms of kind of shrinking that balance sheet and reducing the expansion that we saw in the last few years. And so if we look at really the last time we had a quantitative tightening, it was very slow in the beginning, and it really only accelerated in 2018. That culminated with the bear market in late 2018, and the Fed shortly thereafter reversed course and started another round of QE. And then we got the 2020 pandemic, and they really accelerated that, and of course added trillions of dollars very quickly to the balance sheet. So just some perspective here, we're really just getting started. Of course, at a certain point, the Fed will likely stop or reverse course, but we're nowhere near that point, it seems, today. So what impact is this going to have on the money supply? Well, it's going to have an impact for sure. We're already seeing that. If we look at a 3-month rate of change in the money supply, it's now flat for the first time in over a decade. So expect this to continue. Expect to see declines in the money supply for the first time in a long time. And as we talked about, that's a painful adjustment, but that's a good thing for the long-term health of the economy. So we had this 40% increase in the money supply in a 2-year period. We've never seen that before in the history of the US. That's one of the big reasons why we have this inflationary spiral that we're in. So I'm encouraged by this. We should all be encouraged by this, that we've kind of, at least for the near term, gotten the message that you can't just print your way to prosperity. We have to take some pain here. We have to stop increasing the money supply at the rate we're doing, and we might even need to pull back here. And so a good sign, again, probably short term, going to be painful, adjustment long term. If you want your dollars to be worth something, you need to have a control of the money supply. So what are people expecting in terms of the Fed? Are they done hiking? It doesn't appear to be. If we look at market-based expectations, Fed fund futures, we're looking at 75 basis points in July. So we're going to be increasing 75 basis points to 2.25% to 2.5%. That should read 2.5% there. Then another 50 basis point increase in September, another one in November. December is going to slow down to 25 basis points. And we'll end the year, if the markets are correct, their expectations are correct, we'll end the year somewhere around 3.5 to 3.75%. So significant increase from where we are today. Good news for savers, of course. You're going to see your savings rates and money market fund rates go up commensurately with these Fed fund increase. But the interesting thing looking out a year from today is the market is really expecting the Fed to kind of be done at that point at the end of this year. And not only that, but they're actually expecting pricing in a lower Fed funds rate in July 2023 than where we're going to end the year. So maybe they're anticipating a recession at some point, or the announcement of that, and the Fed may be starting to move back in the other direction. So as we talked about, these Fed fund futures never don't usually do a good job of predicting the future. They're very good when you're entering a meeting. So I think there's a pretty good odds the Fed's going to hike 75 basis points. So they're very good short term, but not very good looking out really long term in the past. And the Fed will continue hiking only as long as they feel like they need to. So the minute we actually see a decline in that headline CPI number, or some of the factors that we've talked about persist in terms of maybe gas prices going down or food prices, the minute we see evidence of that, I think you're going to see a change in the Fed's rhetoric. And they don't want to have to hike to 3.5%, 4%, 5% if they don't have to. So they're going to balance that versus the trajectory of the inflation. So in terms of consumer worker habits, this is a huge transition that we really saw during the pandemic in terms of people not going to the office and then really not going back to the office. And I thought this was a really interesting way of visualizing this from the Wall Street Journal, looking at office occupancy rates in different metropolitan areas. And if we look at the average, the 10-city average of these major cities, we're still less than half, at least less than half of capacity. So half of the people are still working over half the people are still working from home, on a daily basis. So people are in the office less than 50% of the time still. Some cities are more than that. The average, if we look at Texas, seems to be above the average. But places like New York or Chicago or San Francisco, well below the average. So in general, where a lot of things have come back. If we look at pre-pandemic to where we are today, a lot of things have come back. But this is one area that doesn't seem to be going back to the way it was before. And why is that? Well, I just think there's a big demand for workers to work from home. So I'll come back to this as an interesting stat, but I did a poll on Twitter asking if you were given the choice, what would you prefer? Working mostly in the office, working mostly from home, or splitting time equally? You could see a large percentage of people either prefer working mostly from home or splitting time equally. Very few people are in the camp where they want to work mostly in the office. And it wasn't an option, but if it was entirely in the office, I think the percentage would certainly be much lower than this. So the next question then becomes, well, why does the worker get to decide that? Why does the employee get to decide that? Can't the employer just mandate that? They can, but you have to keep in mind what's going on in the labor market. And if we look at the quit rate, while it's down from its high, it's still pretty high. So workers are still feeling like they can quit their jobs. They're still feeling comfortable enough to where they're saying they could quit their jobs and find a new job, where it's still a well above average percentage. So if we look at the balance, and we'll talk about this later in terms of the number of job openings versus the number of unemployed, the employee still feels like they have the upper hand. And I think a second reason is that we really saw during the pandemic that a lot of jobs can be done effectively, either in a hybrid model or not entirely in the office. So if something can be done as effectively, if you can eliminate that expense of having that office space for everyone every day, or eliminate that commuting expense for the employee, it could be a win-win for a lot of companies. Where you have the downside is how it's going to affect cities. So we're going to have to see a big transition in a lot of the major cities in terms of commercial real estate. So this is just an amazing stat that I saw in that article, that Wall Street Journal article, saying that from March 2020 to March 2021, 26,000 New York City small businesses closed permanently. Just an unbelievable number of small businesses closing. A lot of that is due to they're tied to the office economy, and people are not coming in to work. But if you look at office space, up to 125 million square feet of office space available, up from 90 million in the first quarter of 2020. So just a huge increase in available space. And what is that going to do? You have just a much bigger supply, you have lower demand. Well, that's going to cause prices of rents to go down. And we're seeing that for now in Manhattan, 18 consecutive quarters of declining rent for these commercial spaces, the retail spaces in Manhattan. So what we're likely to see, and this is going to take time, is a transitioning from to more residential, from commercial to residential, repurposing these buildings. If we're not going back to that in office every day model, then you're going to need to see a transitioning in how we use the space. So ultimately, that likely means more residential, less commercial, but that's going to take time. And so in the interim, you're likely to see this imbalance kind of right itself through pricing. So again, commercial prices will have to come down enough to the point where you're going to match that supply and demand. So big factor here. It's not just New York City. We're seeing it in cities across the country, and a major transition to say we're not going back to where we were before. Employees, if they have the upper hand, they have the choice, they simply don't want that. And so it'll be interesting to see if a recession does come, if that kind of changes the dynamic where the employer again has the upper hand and says, you got to come back in. But for now, that doesn't seem to be the case. So let's talk about high growth stocks. This has been one of the most hated areas of the market. Went from being one of the most loved to the most hated very quickly. So from its peak in February 2021, this ARK Innovation ETF, which was comprised of mostly high growth stocks, was down 78%, which was the same as the NASDAQ composite from March 2000 to October 2002. And it did so in just 15 months. And what's interesting, the last month here is that the ARK Innovation ETF didn't hit a new low with the broad market. So the broad market hit a lower low in June, but many of these high growth stocks did not. And so that's an interesting divergence. Is it anything more than just a bounce? That remains to be seen. But we're getting to the point where perhaps sentiment got too bearish, and perhaps we're going to see a more sustained rally. So that something I'm watching closely. Maybe this was the first area to go down, and certainly was in early 2021. And maybe at some point when the bear market's over, this will lead us on the way up. So is this it? I don't know. We could certainly see lower lows, but it's something I think that's interesting to watch. And if we look at a poll I did on that day of the low in May, asking what will do better over the next year, the ARK Innovation ETF or the short version of that ETF, a lot of people said the innovation ETF, and so far that's actually been the right call, with the innovation ETF up 27%, and the short innovation actually down 30%. So maybe sentiment got too bearish, at least short term. It certainly seems like it did on these high growth stocks, and we'll see what happens from here. So what's going on in the currency market is really fascinating. I don't think a lot of people would have expected, given what the Fed has done and what the U.S. government has done, for the dollar to be as strong as it has been. But that being said, the reality is that the dollar index is at its highest level since 2002. So just a big advance. And the last few months, it's kind of accelerated. It's actually up 49% from its low now in 2008. And why is the dollar going up? There's many reasons, but if we look at the major components of the dollar index, the two major components are the euro and the yen. And so the dollar is just relative to other currencies, and the euro has been going in the other direction. So the euro is at its lowest level since 2002 versus the dollar, and it's down 36% from that 08 peak. And why is the euro going down versus dollars? A number of reasons. Obviously, economic weakness there is being anticipated. But I think a major reason is this divergence in central bank policy. So the Eurozone recently reported 8.6% inflation rate, same as the US, and the record high in the Eurozone. But if you look at interest rates, they're very different than the story in the US. You still have negative interest rates in the Eurozone, ECB maintaining negative interest rates. So that divergence with the US is pretty big, because, as you know, the Fed is hiking rates. So they hike rates 3 times already, and likely to, as we talked about, continue hiking rates. The expectation is above 3% by the year end. And here you have the ECB still at negative interest rates. So is that divergence likely to persist? Probably not. I think the expectation now is that the ECB is going to finally hike rates when they meet in July, and maybe even end negative interest rates. But in terms of the speed and aggressiveness, for now, the Fed is acting much more quickly. And so you're seeing that divergence with the strength in the dollar, leading to the strength in the dollar and the weakness in the euro. So let's end, as we like to do, with a positive note. I think the strongest argument or counter argument as to why we're not yet in a recession is the jobs market. So typically during a recession, and this isn't always the case, and I'll talk about that in next week's video, you typically tend to see a downturn in employment. It's a coincident to lagging indicator, so you don't have to see it right away. It's certainly not leading. But for now, job market still appears to be pretty strong. So we have, if we're looking at non-farm payrolls, we had another strong report in June. And now we're only 500,000 jobs away from that prior peak. So we lost 22 million jobs in the US in March and April of 2020. And now we've gained back 21 and a half of those jobs. So this has really been the greatest jobs comeback in history. Hopefully it continues. We have the unemployment rate still at 3.6%. So that's just a tick higher than the 50-year low that we saw in February 2020. And again, during a recession, typically see unemployment rate rise. Again, it's not a leading indicator. Certainly could rise from here if we enter a recession. We see layoffs and so forth. But for now, still pretty strong. And if we look at, I think this is very important here as to why maybe this recession, if we are in one, could be a recession without the huge job losses and without the huge increase in unemployment that we've seen in prior recessions. This is the chart showing you the spread between those job openings and the number of unemployed people. And it's still over 5 million. So you still have over 5 million more job openings than unemployed people. So as long as that's the case, that you have such a bigger demand for labor than supply, the employee has the upper hand, and you're not likely to see as many as many layoffs or job declines overall. We're certainly hearing it in tech, and we're starting to see it in certain areas, but you're still seeing a lot of help wanted in many other industries. So if we look at what this is doing to wages and hourly earnings, it continues to put upward pressure. So of course, if you have more of a demand for labor than supply, the employee has the upper hand to incentivize people to work and to come join your company. You have to offer higher wages. And we've seen this continue, another record high in hourly earnings, $32 an hour now, up 5%, a little over 5% in the last year. And so with many signs of weakness, I think the jobs market is the one standout. Again, hopefully it continues. I want to see that jobs number hit a new high this year. I hope that it does. And so with that, we'll end the video. Thanks everyone for joining me. Have a great week ahead, and we'll see you next week. Thanks.